What's up everybody, Nate here, and the entire United States, from the stock market to the average everyday American, has been watching the Federal Reserve super closely to see what they are going to do in order to combat inflation and not send our economy into a recession in 2022. And while Federal Reserve Chairman Jerome Powell has not said exactly how much the Federal Reserve is going to raise its benchmark interest rates in 2022, some of the other Federal Reserve presidents have come out and given their opinion on how much the Federal Reserve is going to raise interest rates this year. And so far the numbers are pretty crazy. The president of the Federal Reserve in Atlanta, Raphael Bostic, said that he would not be surprised if the Federal Reserve actually raised interest rates 3 times in 2022, but raised them by around 50 basis points. That is 25 basis points more than what the stock market was anticipating to happen. And then, just to keep things interesting, the Fed chairman in Minneapolis, Kashkari, said that he anticipates the Federal Reserve raising rates just 2 times this year and then pausing after the spring to see how the economy is doing, just really wait it out. But it doesn't stop there, because you also have a ton of other financial institutions, like some of the biggest banks in America, throwing their hat in the ring and guessing how many times the Federal Reserve is going to raise interest rates this year. With Goldman Sachs saying that the Federal Reserve could raise interest rates 5 times in 2022, and Bank of America thinks it'll get even more aggressive, raising interest rates a whole 7 times, and we haven't seen that done since 2000. So today I want to talk all about the Federal Reserve, interest rates, and all of these predictions that these banks and other Fed presidents are coming out with in regards to how much the Federal Reserve will actually raise its rates this year. But before I break all of this down, do me a quick favor and smash, hit, or destroy that thumbs up button below, and hit that notification bell as well. It's completely free to do both of those 2 things, and it really shows me that you really like this video and that you want to see even more just like it. Thank you so much for doing that. Now let's talk all about the craziness behind the Federal Reserve. So all eyes have been on the Federal Reserve for the last few months. The reason being is because the Federal Reserve has talked about getting aggressive with its interest rates and its stimulus money in response to inflation. Inflation hit a 40-year high of around 7% by the end of 2021. And not only that, but every single key inflation measure has been rising over the last 2 years. And it's safe to say now that inflation is the highest that it's been since the late 1970s and early 1980s. And this is the perfect realm for the Federal Reserve, because it's their job to monitor inflation and then make sure that we have monetary policies that are going to lower inflation and keep it at a healthy level in the United States. But their narrative over the last 2 years has not really reflected that. You see, since probably the middle part of 2021, Jerome Powell, the chairman of the Federal Reserve, has been saying that all of this inflation that we're facing right now is completely transitory. Transitory basically meaning that inflation is going to go away and it's nothing to really worry about. Well, let's just say he was a little off on that prediction, because inflation is getting out of control in the United States. Now, what exactly does that really mean? Well, by definition, inflation just means that the monetary supply of a country is going up. So the Federal Reserve is in charge of telling the Treasury Department how much money it needs to print every single year. The reason the Federal Reserve is in charge of how much money we print is that it's an independent body, secular from the United States federal government. It's not supposed to have any political affiliations, which will help it make independent decisions on what our monetary supply and policy needs to be in the US. That also kind of means that it just does whatever it wants sometimes. Now, when the Federal Reserve decides that it needs to print money, it does so for a reason. So the Federal Reserve will print money in response to a bill that needs to be funded from Congress, or it'll print money because there is a demand for money in our United States economy. They like to see an inflation level of around 2 to 3% every year. So that basically means that if something costs $1 today, a year from now, it'll cost around $1.02 or $1.03. However, it has not stuck to that, because inflation hit a 40-year high of around 7% at the end of 2021. Now, what that ultimately means for the stock market and everyday Americans is that the price of everything is starting to go up. The CPI, or the Consumer Price Index, basically gives you an average of how prices are increasing or decreasing every single month. So that's how we know inflation is going up right now. The average price of everything in our United States economy is going up by 7%. So things are starting to cost more, and that can be a problem if things start to cost more way too quickly. And that's what's going on in our economy right now. When the price of everything goes up in our United States economy, well, that means that Americans need more money in order to buy all the same things. The buying power of all of our dollars goes down because the value of our money is decreasing. So if Americans need more money to buy all the same things, well, where exactly does that money come from? Well, that money all comes from their employers. For the majority of Americans, that's where they get their money from, is from their income at their job. But you gotta think, for some of these big companies and corporations, they can't just shell out extra money for free. All of that is going to come at a cost to the employer. So they give out wage increases to all of their employees, but they also recoup some of those costs by raising the price of all of their items. So really, nobody makes any additional money. It all just kind of works out evenly, and normally that's not really a problem when inflation is around the 2 to 3% mark. However, this is a huge issue in the United States right now. Real wages actually decreased by around 2.4% in 2021, while inflation was around 7%. So Americans are losing money. The price of everything is going up too. So that leads us into the Federal Reserve and what they're doing now. So throughout 2021, they called inflation transitory because inflation was being caused by all of our supply chain issues. You see, when the Federal Reserve and the United States government printed trillions of dollars in stimulus, well, that gave Americans trillions of dollars to spend. They started buying things at record rates, and before you know it, we didn't have anything on our shelves. That created supply chain issues, and just based on supply and demand, if we have a low supply of something but a high demand for it, well, the price of that thing is going to go up. Our supply chains in the United States are just now starting to improve, but they are definitely nowhere near what we saw in 2019. So Americans still have a lot of this free money from the United States federal government and the Federal Reserve. All of that money is starting to go away, which is creating problems in our economy, and it's something that the Federal Reserve is now starting to address. So how do you kind of fix this free money problem? Well, the only reason that we had a lot of our supply chain issues is because we had such high demand in the United States. If the Federal Reserve can take that demand away, then the American people won't have as much money to spend, and that means inflation can naturally start to decrease. And the Federal Reserve has reflected that in its newest narrative, saying that they are going to get more aggressive with inflation now than they've ever been in their almost 100-year history. They're cutting off a lot of the free money that they've been giving Wall Street. They've racked up a balance sheet of around $9 trillion after buying mortgage-backed securities and corporate bonds on the New York Stock Exchange. That is going to start to disappear as of March 2022, but also interest rates are scheduled to go back up starting in 2022. The problem is the stock market is kind of playing a guessing game right now because they don't know how much interest rates are going to go up by. Some experts are saying that they're going to go up by just 25 basis points every single time the Federal Reserve raises their rates. However, not everybody agrees that that is what we need right now. The president of the Federal Reserve in Atlanta believes that we need to raise interest rates by 50 basis points 3 times in 2022. Here's what he said in a recent Financial Times interview. If the data says that things have evolved in a way that 50 basis point move is required or would be appropriate, then I'm going to lean into that. If moving in succession meetings makes sense, I'll be comfortable with that too. So basically, he's saying that if 50 basis points are warranted, meaning that the country and the stock market would actually benefit from that, well, then 50 basis points is what the Federal Reserve is going to do. That would be incredibly aggressive compared to what they have done in the past. However, the Federal Reserve chairman in Minneapolis kind of disagrees with this notion. He says that he would be comfortable with raising interest rates a few times in 2022. However, quote, "Is it conceivable we could move in the spring and then pause and see how the economy evolves? That's completely conceivable. I don't want to prejudge it just yet. So it sounds like the Minneapolis Fed chairman is saying the complete opposite here. He's saying that the Federal Reserve can raise interest rates, but essentially pause to see how the economy is doing. Those two theories don't even compare to Bank of America and Goldman Sachs. Goldman Sachs believes that the United States Federal Reserve is going to raise interest rates, or needs to raise interest rates, 5 times in 2022. And even that's a lowball, considering Bank of America says that we need to raise interest rates a whole 7 times this year. Now let's actually talk about what that would really mean. The Federal Reserve has 2 choices when it comes to its monetary policy. It can drop its benchmark interest rates, or it can raise them. It dropped them in 2020 because it wanted to incentivize people to go out and get money. Buying things is how our economy functions. The more spending, the more businesses can actually grow. So when interest rates are super low, that allows more people to go out and get a bigger loan so they can buy even more things. That's part of the reason why we saw the housing market explode in 2020 and in 2021. Interest rates were so low that people could get a very low interest rate on their mortgage and potentially save hundreds of thousands of dollars over the lifetime of their loan. But then you have the opposite side, the Federal Reserve raising its benchmark interest rates. Now, raising its interest rates means that they want to curb demand. They don't want people having such easy access to free money. And eventually what that means is spending is going to go down in the United States. And again, if this is all controlled and at healthy levels, it's not really a problem because inflation typically fluctuates between 1% and 3% every single year. This is why you typically see a lot of companies and businesses give their employees a 2 to 3% raise every single year. The reason for that is because they want to keep up with inflation. If they never gave their employees a raise, well, then their workers would never be able to afford things because soon everything would be out of their price range. And employees are gonna realize that and they're gonna quit their job and go find a new one. And in case you didn't notice, millions of Americans right now are quitting their jobs. And the reason being is because employers are not paying them enough to meet inflation. I mean, there's a variety of other issues like the work from home culture shift, people searching for a passion instead of a paycheck, and employees just punishing bad employers for not treating them right during the pandemic or just in general. But that has led to the Great Resignation, which has only amplified our supply chain issues, which has led the Federal Reserve to talk about getting aggressive on inflation. Now, this has vast implications for just about everything in our entire economy. Raising rates is going to, for one, affect the stock market because when the Federal Reserve raises its benchmark interest rates and pulls all of the money that it's been buying in bonds from companies on the stock market, well, that means businesses and investors can no longer make a lot of their risky moves that they were making before. Investors have to start being very careful with their money. They can't just dump money into an unproven stock anymore. They have to use their money effectively, and that might mean pulling it all together. That is what we've started to see in January 2022. Investors are moving their money around because the risk is starting to get a lot higher. Back in 2021, the risk was so low because there was so much money going around that investors and businesses alike could throw it at basically whatever they wanted. And remember, it wasn't their money, it was the Federal Reserve's money. Now, they're only playing with their money. And when their chips are on the table, well, they're gonna be a lot more frugal. Not only that, but risky assets are going down too, like Bitcoin, Ethereum, and the cryptocurrency market in general. Investors are losing that free money, and it's harder to start trading on margin because rates are going up too. Number 2, the housing market is dipping as well because remember, the Federal Reserve was buying corporate bonds and mortgage-backed securities. Now that they're pulling all of that mortgage-backed security money, well, that money is disappearing for all of these banks. They now have to be a lot more strict about who they give a mortgage to, which means rates for them are going up too, and that could mean bad news for our economy. Banks are gonna make a lot less money here, which means people are gonna have a lot less chances to get a mortgage or an auto loan or a personal loan or just any loan for that matter. That all equals less spending because if your rates go up, well, remember before you could save hundreds of thousands of dollars on your mortgage. Now you're losing that money and you just can't afford afford a mortgage or an auto loan anymore. So you're just not gonna spend any money. And remember, that means shrinking. And finally, number 3, if inflation continues to rise, then that could mean even less spending for Americans all throughout the country, because remember, wages aren't really keeping up with inflation. So Americans are only going to be buying their necessities. And that leaves us to the ultimate question: how many times is the Federal Reserve going to raise rates in 2022, and by how much? Well, this ultimately depends, because it depends on how our economy is recovering from the pandemic and what it's going to look like in general. What would cause them to raise rates in the first place? Well, the reason that they can raise rates is because they believe that our economy is going in the right direction. They feel that the economy is starting to get healthier. We can measure if the economy is starting to get healthier by a few different metrics. For one, labor participation, which is a little bit different than the unemployment rate. The unemployment rate in the United States right now is just below the 4% mark. That basically measures how many people actually lost their jobs during a particular period of time and had to file for benefits. However, labor participation measures how many people in the United States that are able to work are actually working. Getting that number to 100% is what the Federal Reserve is looking at, because they want as many people in the United States to make money. That will help them raise rates, because even though inflation is still going up, well, now you have everybody in the US spending more money. So you're not really making much more money, but everybody is able to spend now. That'll ultimately help us measure GDP later on, and GDP is exploding right now in the US. It's starting to go up with the Federal Reserve to know that they can raise interest rates. Number 2, though, it's going to depend on earnings reports on Wall Street. So if earnings reports continue to be super positive for companies, well, then there's no reason why the Federal Reserve can't raise its benchmark interest rates. This basically shows that companies are still making money, even though inflation is high and there isn't free money circulating throughout our economy. That's a good sign, because it can show that our economy is starting to recover and getting healthy again. But if we start having really bad earnings reports on the stock market, well, that might signal to the Federal Reserve that people aren't spending as much and consumer confidence is continuing to decrease. All of that combined is what the Federal Reserve is going to look at when they start raising their interest rates. If everything is going in a really solid direction, well, then that 50 basis points raise isn't looking too crazy right now. But if companies and markets all throughout the country are basically in shambles, well, the Federal Reserve still can't do nothing, because they have to fight inflation right now. So they're still going to raise their interest rates, but they might just be a lot lower and a lot slower. So that's basically how things could shape up in 2022. If our economy is super healthy, and interest rates will go up faster and be a lot higher. But if our economy and businesses are struggling, then you'll still see some interest rate hikes, but they'll be a lot lower and slower. But now I want to hear from you on this issue. What do you think about the Federal Reserve raising interest rates in 2022? Do you think that they'll only raise interest rates a few times, or do you think that Bank of America is more on point, saying that interest rates will go up 7 times? Be sure to join the conversation below and leave a comment before you go. But that is it for me, everyone. I hope you liked this video, and if you did, be sure to hit that subscribe button below. Be kind out there, and I'll see you all in the next one.